This is like a secret tax settlement program that's more popular than anything else. The PPIA is a back-end tax settlement solution that's more widely used in the offer and compromise and the non-collectible status. I'm gonna show you a crazy example of how this system works. This is data from a client that I'm gonna call Joey. It's a crazy case, but I'm gonna just sum up on one of the tax issues that we had. When I first met Joey, his tax balances with the IRS were over $400,000. Upon reviewing his case, he had a couple assets and he did not qualify for the offer and compromise program. Equity in his house, retirement accounts. Mind you, he did not live a life of luxury, and the reasons why he got in trouble were for many different reasons. Some had to do with unfiled taxes, he was self-employed, and things got out of control to the point that it ballooned up to $400,000. Regarding tax problems, there's always a breakdown of year by year of what somebody owes. And regarding the snapshot that we do for every single client, we not only get the year-by-year breakdown of the tax balances, we also get what's known as a 10-year rule, which means that the moment you owe the IRS money, the IRS only has 10 years to collect. Everything with the IRS is about time and law. So when you owe the money, this is known as the Collection Statute Expiration Date, 10 years. Now, something very important about the 10-year rule and how it applies to Joey's case is that there are certain events considered as tolling events that extend the 10-year time frame. It won't start from scratch, but it's like a pause button and an extension of time. Some of the reasons may include the time that you file bankruptcy, or you might go through an offer and compromise that fails, or if you go through an official route of appeals through the IRS known as the CDP hearing. And when I first met Joey, I showed that he underwent many different offers and compromise, bankruptcy, and other tolling events that extended the time frame. And some of the balances on the year-by-year breakdown were getting pretty old. So the number one solution is the PPIA, the Partial Payment Installment Agreement, also known as a Hardship Payment Plan. So I calculated a payment plan that's going to be under $300 a month. And this is the PPIA in action. As long as he's making the $300 a month, he's not going to be subject to any collection action. And after making payments on this in 1 year, the balances, because of the 10-year rule, are automatically going to drop to about $300,000. And in another 2 years, it's going to drop down another $200,000 less, leaving him a balance of $100,000 with the IRS. Which, sure enough, with the final balances on his collection statute date, his balances are going to be down to zero in 3 additional years. And that is why the PPIA is a back-end tax settlement, meaning because of financial hardship, you're not able to pay your taxes. And the IRS will review your financial situation and accept the payment plan that you are able to pay. And if you're facing IRS tax problems, IRS tax debt, unfiled taxes, I'm more than happy to review your case and see what's the best possible solution, whether you qualify for the PPIA, the offer and compromise, non-collectible status, or one of many of the other tax relief programs you may qualify for.